Candlesticks, trading volumes, support levels. If you've heard these terms times and times again but don't really know what any of them mean, you've come to the right place. In this video, we will teach you how to read cryptographics like a pro. My name is Anna. Let's get started. The theory of Charles Dow, an American journalist and one of the founders of Dow Jones & Co., talks about the basic market principles that are equally true for the cryptosphere. The price of an asset takes into account all factors. The current price of an asset is determined by events that have occurred in the past, are occurring in the present, and are expected in the future. The current price takes into account and reflects all currently available information about the asset. History repeats itself. This means that price patterns are repetitive and reflect the psychology of the market. They signal a change in trends or confirm the persistence of existing ones. The market is not random. Price moves clearly follow trends. If a trend has formed, it is likely that the price will continue to follow it, and not vice versa. A trend is a move in the price of an asset in one direction with an update of its highs and lows. Now, let's move on to the charts. A chart is a visual display of changes in the value of a coin. By looking at the price history on the chart, you can form an opinion about the ideal purchase price, upside potential, and duration of the asset held in your portfolio. Most investment strategies are based on a preliminary analysis of the price chart of a cryptocurrency. At the moment, the Japanese candlestick chart is thought to be the most popular and informative one. Each candlestick, a graphical display of price changes of an asset, contains information about the price change for the selected time interval and displays the following information. Opening price, the price of the first transaction for the selected period. Closing price, the price of the last trade. The white part of the candlestick is its body. The body of the candlestick displays the distance between the opening and closing prices. If the body is green, it means that the opening price is lower than the closing. The asset grew in price. And if it's vice versa, the body is red. Shadows are the lines above and below the body of a candlestick on a candlestick chart. The upper shadow is referred to as the wick, and the lower shadow is the tail. They represent the highest and lowest price points of the selected period. The next thing you need to know is the time frame. This is a period when price moves take place. To successfully trade crypto assets, you need to analyze time frames from the oldest ones. The daily chart is usually used to determine and track the global trend. Then, the 4-hour periods and hourly charts help with local price updates. Each candle shows price changes during the given period. These are the kinds of time frames: M5, M15, M30, minute time frames, H1, H4, hourly time frames, D1, a daily time frame, and W1, a weekly time frame. Also, to understand the crypto price fluctuations better, you need to understand the trading volume. It's one of the most important conditions for qualitative analysis. The levels of trading volume on the chart indicate the degrees of interest of market participants in particular crypto. Trading volume is the number and size of transactions made during the selected period. High trading volumes confirm the direction of the price move and indicate high liquidity, the ability of an asset to be sold quickly. General trading data is represented by a bar chart with vertical bars and displayed at the bottom of the chart. Each candle on the chart corresponds to a column. The height of the column shows the trading volume for the given period. A bar chart or bar graph is a graphical display of data using bars of different heights. The color of the column shows how the price has been moving. A gray column means that there were more purchases in the given period. A red column means that there were more sales during the given time. Now, let's take a look at the trends. A trend is a move in which each subsequent high and low in an asset's price becomes higher on an uptrend or lower on a downtrend. The price of cryptocurrencies moves only in 3 directions. Up, uptrend, bull market, price is rising. Down, downtrend, bear market, price is dropping. Sideways. Horizontal consolidation, the price bounces at the same level. According to the Charles Dow theory, there are several different trend moves in the market at the same time. As a result of these moves, local highs and lows, the highest and lowest price values in the selected range, upwards. The primary trend shows a general, long-term, 1 year or more, trend of price moves. Secondary trend demonstrates medium-term, from 3 weeks to 3 months, changes in the primary trend. Minor trend demonstrates speculative price changes in the short term, less than 3 weeks. The crypto market has several phases. The accumulation phase is the starting phase. At this point, the big players start accumulating their positions. This phase begins at the end of the downtrend. The beginning of the accumulation phase in most scenarios is accompanied by a long horizontal trend, public participation or big move phase. When the trend reversal becomes clear on the chart, the big move phase begins. The trading volume and the number of market participants increase. The media fill the news sources with favorable news. Price highs are regularly updated. Access phase. After reaching price highs, experienced players begin to close their positions and take profits. Market beginners, as a rule, believe in the continuation of the upward move and are just starting their purchases. Thus, they help experienced players sell their accumulated assets at a high price. This phase is a reversal. These phases can be different depending on the market conditions. In a bull market, these are the accumulation phase, the public participation phase, and the access phase. In a bear market, these are the distribution phase, the public participation phase, and the panic or despair phase. Finally, let's talk about the price levels. The support level is the price level on the chart from which the price rebounded while moving in a downtrend, that is, from top to bottom. And the resistance level is the price level on the chart from which the price rebounded while moving in an uptrend, that is, from bottom up. Support and resistance levels are price zones on the chart approaching which the price historically changed its direction or slowed down. The formation on chart may indicate further price moves. Support and resistance levels can be pivot points, overbought areas, or simply important price zones. These levels are formed by increasing the number of buyers or sellers in key price zones. Support and resistance levels tend to reverse roles with each other. That is all we're going to cover in this video. You can always find more information about crypto and check your knowledge in our new app, SimpleLearn. It is completely free, the link is in the description. If you found this video helpful, please leave a like and subscribe to our channel. And if you have any questions, feel free to leave them in the comments. Thank you for watching. We will see you very soon.